All right, let's get started. So I'm going to go to the next slide. So we will always start with a disclaimer. So any of the information in this presentation is general information, and you shouldn't think of that as being advice for your own situation. Whenever you're looking at insurances, please look at the product disclosure statement to see what is good for you. And yeah, cool. Let's roll over to the next slide. And for the agenda today, I'll just quickly run over this. So we'll give a recap on what personal insurances are. The next big section will be with the insurance that's in your super fund, is that enough? 3 will be what are the major differences between insurance inside super and insurance that's outside super, which is what we as advisors provide advice on. And we'll look at some real life case studies that we've looked at today from our own clients. We'll also go through some common myths about life insurance inside super, and then we'll also have a lot of time at the end for Q&A. So if you have any questions at all, feel free to put them into the chat, and we can actually come back and answer those questions at the end of the presentation as well. Okay, so start off with you, Matt.
Awesome. So what is personal insurance for a start? Well, there's a few different types, but it's, as the name suggests, it's personal. So it's not like your typical house and contents or car insurance where you can call someone up and have some cover in place within 15 minutes. So the biggest thing I say to my clients when we're getting started is you go through a lot of effort up front, but the perk of that is when it comes claim time, you've already gone through that effort and you've done it when you're young, you're healthy, you don't have a potential claimable event on your mind at the moment. So that's the best time to do it rather than answering a million questions about your health and your job and your pastimes when you're trying to claim due to a disability or injury. So there's 5 main types of cover that we look at within that personal insurance. And so the first one is life cover. So also known as death cover. Most of you will be able to figure out when this will actually pay out. Essentially, it pays out a lump sum benefit if you die or if you're diagnosed as terminally ill and you have a life expectancy of less than 12 to 24 months. Depending on the product, some are 12 months, some are 24. So ideally, you want to look at those products that have that longer time frame because you don't really want to only be given 12 months and then be scrambling to get your cover paid out before you pass away. So the purpose of that cover is not so much for you, it's for those around you that are financially dependent. So I stress the financial part, financially dependent, because it'd be really, really awful if I said, you know, if you passed away, no one would be affected. It's financially affected that we're looking at. So what we want to do with life insurance is if you've got a family, you know, we want to look at replacing a couple of years of your income so that if you had schooling plans or university or they just have hobbies that you want to make sure they can keep doing, even if you were to pass away, we put aside some money for that. We want to make sure everyone has a roof over their head without any ongoing rent or mortgage. So we look at clearing the family debt or the mortgage that's on the family home. And the last thing there is to cover off funeral costs or other associated costs that might come up if you were to pass away. So there's costs that come along with managing your estate. There's all sorts of other costs that might pop up. So those are the main reasons or numbers that we look at when calculating the needs for our clients. Kat, do you want to take away TPD?
Yeah, so TPD, so that's short for total and permanent disability insurance. And so what that does is if you were to make a claim, you're paid out a lump sum, and that's only if you are totally and permanently disabled and unable to work again. So if you're wondering when that would happen, it's normally you've already been off work for some time and 2 doctors have actually agreed that you cannot return to work again. So it's very serious circumstance where you cannot return to work, and that could be due to illness or injury. And when we look at calculating the amounts that you need for TPD insurance, we look at replacement of income, mostly to do with replacing income that can't be covered by income protection insurance. That's another type of insurance that we'll look at in a moment. We also would like to look at clearing any mortgages or maybe even allowing you to purchase a home if you're renting, because if you were to no longer be able to work, you probably don't want to be dealing with mortgage repayments or rent anymore. And finally, we also include an amount to cover for medical costs. So if you have any large medical bills that's due to you being totally and permanently disabled, or maybe you might need to make modifications to your home or to your vehicle, things like that. So that's what we look at with the total and permanent disability insurances. Okay. Next is the income protection.
Alrighty. So like Kat said, income protection somewhat ties in with total and permanent disability because they both look at your inability to work due to an injury or an illness. Unlike total and permanent disability, income protection can pay you out for the short, medium, or the long term, depending on what sort of benefit period you have. And it can be paid out in a lot less severe events. So TPD, as the name suggests, it's total and permanent. You need those two doctors to sign off that you can't ever work again. Income protection, it's pretty much as simple as, can you currently work due to this injury or illness that you've suffered? If the answer is no, then once you've hit your waiting period, which is the amount of time you need to be unable to work due to this injury or illness, then you start getting that monthly payment, and that'll carry on for as long as that benefit period or until you go back to work. So that's where that short, medium, or long-term claim comes into play. So what it can be used for, really just replacing your income. The other thing or part to that kind of ties in is actually replacing superannuation contributions. So at the moment, you get paid in two ways. You get your monthly, weekly, fortnightly pay into your bank account. You also get an amount paid to your super fund, unless you're self-employed, maybe you pay yourself a little bit of super. But if you're an employee, you've got that 11% going into your super fund. Now that super fund, you may not be paying too much attention to it, but the point of that fund is to then look after you in retirement. So if you can't work anymore because of an injury or illness, doesn't mean you're no longer going to retire. You're still going to get to 65, hopefully. You're still going to need all those funds you would have had if you'd been working. So you can actually get an extra benefit added on to that income protection that pays an amount directly to your super fund, so that if you do end up claiming for a really long time or all the way through to age 65, you've not only got that regular amount paid into your bank account, you've also got those amounts contributed to super, because the maximum benefit period for income protection is typically age 65. And so it'll stop on your 65th birthday. And then you need to rely on assets, family, friends, or hopefully superannuation that is built up through employer contributions and this long-term benefit from income protection if you have it. So we just want to make sure that if you can't work, that income that you absolutely need still comes in through the door. And most products you can get these days cover 70% of your income. So it's not a crazy calculation to figure out how much you need. It's typically 70% of your income divided by 12 gives you your monthly benefit, and then plus or minus that super benefit on top.
Okay, so the next one is trauma insurance. So trauma insurance you might not be so familiar with because you can't actually have it through super. But what trauma insurance does is it pays out a lump sum benefit if you're diagnosed with a serious illness. And the three most common types are cancer, heart attack, and stroke. And I want to stress that it does pay out on diagnosis. So you don't need to necessarily wait until you're, say, at stage 4 cancer before you can actually make a claim. You can actually have quite an early diagnosis, early stage cancer, and still be paid out your full trauma insurance. And what trauma insurance can actually be used for is numerous things. One of the main components that we look at when we're calculating how much to recommend is medical costs. So we like to put a certain amount towards medical costs, generally around $100,000 or more. So this can help you go towards any medical bills that might go beyond what Medicare or private health insurance will cover you for with any treatment or any things like that. We also would look to replace your income. So what we generally like to do is to cover, say, 30% of your income for 1 year. And then in the event that you also can't work due to maybe you're needing to undergo treatment or you're simply unwell enough to work, you can also claim on your income protection at the same time. And as Matt mentioned before, that covers 70% of your income. So put that together with the trauma insurance, you could effectively have a whole year's income replaced. So that way you can just focus on recovery and getting better, and you're not stressing about needing to go back to work straight away so you can pay for your bills. We also, if we're helping couples, we would also look to replace the healthy partner's net income as well. So they have the flexibility to take some time off of work to look after the ill partner, maybe take them to appointments, help more around with the family, with the house, things like that. And just being able to provide for additional care for the children as well. So that's what we look at with trauma insurance. Okay.
Thanks, Kat. And then the fifth type, and probably the least known cover that we look at in some cases, is child's cover or child's insurance. So it's a bit of a hybrid between the adult trauma cover and the death cover, because it is owned by yourself. However, the life insured is actually your child. So each product from each insurer is so slightly different in the entry ages. So the minimum age they will actually allow your child to get some cover, as well as the maximum age. So that can range anywhere from 17 through to 21 or 23, I think I've seen recently. And then at that point, depending on which insurer you're with, that cover will either just expire or it will convert into a different adult policy. So it'll either become just a plain old death policy, or it might become a trauma policy for your child without too much extra paperwork. So it's almost just like a head start for your kids. The main reason for it, though, is while they are young, while they are super dependent on you, if they suffer or are diagnosed with a serious childhood illness, such as cancer, heart attack, or stroke, or if they pass away, or if they're deemed terminally ill, you get a payment. Now, that payment is not so that you can benefit off your child's illness. It's there so that if they need treatment, you don't have to wait in the public health system, or you don't have to fork out your own money for going private. You get this insurance payment, and you throw absolutely everything you can at making sure your child has the best treatment possible at the soonest possible time. So whether that's going overseas, I've heard stories of people actually going overseas to get these sometimes experimental treatments that are just not available in Australia. And that payment is for that reason. So it's your last resort, essentially. Can also, if you need to take time off work, your income is not going to keep coming in unless you have heaps of personal leave. So that's what that is for. So you can just drop everything else in your life and focus on helping your child get better. So it's a horrible cover to talk about and to think about, or at least the scenario around having to have a claim on it. But it's incredibly important because unfortunately these things do happen. You can just pop into GoFundMe and you'll see some tear-jerking stories about adults as well as children that have suffered these type of events and are going out and asking the public to please help in any way they can, because it is expensive. And it's not just any potential medical expenses, it's a loss of income as well on top of everything. So the hope there is it can at least ease the financial burden so that you can spend your time on whatever other remaining burdens there are, or just getting better, or being there for your kids or your family.
Right. Okay, so now we will touch on super fund insurance. So what is super fund insurance? So it's where the trustee of your super fund purchases an insurance policy to provide cover for a group of superannuation fund members. And the default insurance amount that you get when you have these insurances issued is determined by a common formula. So if multiple people start with Australian super fund, they will likely have the same amount of cover if they enter at the same age. And it is generally determined by both entry age, and also it can sometimes differ depending on, with particular super funds, depending on what type of occupation you're doing as well. Okay. And on the contrary, we have retail insurance. So retail insurance is you have this set up through an advisor. It's not generally available through your normal super fund that you would have. And with retail insurance, that cover is actually medically underwritten. So what that means is that you're assessed on your full medical history when you're applying for the insurance. And once you have the policy issued, those terms cannot be changed. So say you take out the cover when you're young and healthy, like Matt suggested earlier, and you have the insurance is issued to you at standard rates, which means you have no exclusions, no loadings. Even if you were to say hurt your knee in the future, that will not affect your insurance because you already have it. The terms can't be altered. And yeah, so the best time to take up retail insurance is the earlier, the better. Yeah. Okay.
So the next couple of slides, all we're looking at really is the insurance in your super fund enough? So we're not talking about quality, we're not talking about price yet, anything else. It's purely, if you were to suffer one of those events, does the super or the insurance cover you've got in your super fund, is it going to be enough to pay for those things that you need? So earlier on, when we're going through the different types of insurance, we talked about what we typically look at for our clients. So like if you can never work again, making sure you either can pay off your current mortgage or purchase a property, replacing a percentage of your income through to 65, paying off potential for tax if you were to withdraw that money from super. So what we typically find is the default levels of cover that is just automatically given by these super funds is just not very high. Now, they have to play a bit of a balancing act because they want to give some insurance to people, but at the same time, the more insurance you have, the more you pay for that cover. So they don't really know what's going on with your situation. So it'd be all well and good for them to give out $1 million worth of cover to everyone on the assumption that we all have these huge mortgages, earn lots of money. But for the people that don't fit into those categories, all they end up doing is paying for a heap of insurance that they may never even need. So the insurers, the super funds do have a bit of a hard time figuring out just how much to give to their members, where they're covered enough, but also not paying for excess insurance that they don't actually need. So we've just got some numbers here. I think this was from the last ABS, what do they call it? The census? Yeah, that's it. So average income, 71,583. So that's inclusive of full-time, part-time, and casual. So if we took out part-time, casual, probably maybe a little bit more than that. Average debt levels, 585,000 for new loans. Now, I'd be really, really interested to see what those figures are in the last 12 months. I'd say it's a fair bit higher than that. And then across Australia for all home loans, $356,000 is the average. So that would then include, maybe your parents, grandparents who still have a little bit to pay off their mortgage in their later years. And then fun fact, super funds actually do insure over 15 million Australians. So what's that? 3/5 of all of Australia. So I think most people do have these covers, whether they know about it or not. But that's why we do this sort of thing, is to go, well, cool, you've got cover, but make sure it's right for you. Maybe you want to up it so that you're actually protected for the things you need. But if you've got too much, reduce it or cancel it. Save that money if you don't need the cover. So what we've actually done is we've gone through the insurance guides or the product disclosure statements from three of the biggest super funds in Australia. And we've added in a fourth super fund, which is very well recommended by a certain barefooted individual, just out of interest. I think that particular fund is actually the 10th biggest, at least it was at the time of looking into this. And this is not to, put down any of these super funds. It's literally just to show, if you have never looked into it, the maximum levels of cover that you might actually be given without increasing it yourself. And you might find it's surprisingly low. So with Australian Super, how they typically do it, it's called age-based cover. So depending on when you join that fund and what age you are each year, there's just a big table and it says at age 25, 26, 27, this is how much life cover will give you, and this is how much TPD cover will give you. So that's another really important factor as well, is whatever you see or saw last year in your super fund doesn't necessarily mean that same amount of cover is still there. It may have increased, it may have decreased. And that's really important, because it's not just how much you get paid in one of those events, how much you're paying for that insurance, because it typically gets more and more expensive, even if that super fund is with reducing that cover. So just looking through here, the highest level of life cover you'd actually ever have with Australian Super without ever touching it yourself is 183,000, which is not a huge amount, but if you're young and you've got no dependents, you're not sharing a mortgage with anyone, that's probably going to still be more than enough. However, total and permanent disability, so the highest level of cover there, $61,000 at the age of 29. That's less than that average income we looked at on the previous slide. So if you could never work again, would you be super stoked if I said, here's $61,000
For the rest of your
all
life?
the best? Yeah. So that's the biggest thing we notice when we look at someone's existing cover, is that TPD figure is generally far lower than most people would actually need. And then looking at the, this is the income protection cover amounts. So again, income protection covers up to 70%. I think through some of these super funds, they offer up to 75 or even 85%, where 10% of that is for super replacement. But between the ages of 38 and 46 is the highest amount you'll ever get, which is $3,100 a month. So that in itself is not very much cover at all. I'm not going to do the quick maths, but I think that's cover for probably 60 or 70,000. Kat, I'm not sure if you have a calculator handy.
I do. Wait, I'll quickly work it out. So 3,112 divided by, well, that's not much at all, really. Yeah. 53,000 per year. I think most people would generally think that they're on more than that if they're working full time and they've been working for some time. Maybe when you're first starting off, that might be enough, but I'd say the majority of our clients, that's nowhere near enough. Yeah.
And saying that, when you're first starting out, maybe you're earning roughly around that amount, but for a 25-year-old, they're only actually offering 1,900. So it's still far less. And the kicker to all of that is you still pay tax on income protection payments. So whatever you see in that amount, take out a percentage of tax depending on what your marginal tax rate ends up being. So it's not that you'll get 1,900 in your bank account. It'll be a little bit less than that. So same again, we've got a very similar slide for 3 more times, but this is Australian Retirement Trust, so ART. So their default levels of cover a little bit higher here. You can see at around age 30 to 33, they're giving you $250,000 worth of death cover and a nice $250,000 worth of TPD. I know me personally, if I could never work again, I would need quite a bit more than that. But what you'll see through these 4 different super funds that we've looked at is that up to the age or between the ages of kind of 21 and 35, you'll see these amounts of cover typically increase each year slightly. After age 35, they begin to decrease. So kind of right when you're in your maximum earning potential, probably have the biggest amount of debt that you're going to have throughout your life, they automatically start bringing down those cover levels. So you can see between the ages of 40 and 45, nearly $50,000 worth of cover has been reduced. And they won't point this out to you. It just happens. If you don't see it in your annual statement, you won't even notice that happening. Kat, do you want to talk about Aware?
Yeah, so with Aware Super, looks to be, so you can get some cover when you're 15. That's actually quite an early age to be getting some cover. The highest level of cover you will get looks to be when you're around age 30. So 224,100 is the amount for both your life and your TPD insurance. But as we mentioned before, if you were no longer able to work again, 224,000 for the rest of your life to your age 65 probably isn't really going to cut it. Just looking at, do we have the income protection amounts as well? I'll go with Host Plus Super. So Host Plus, Mr. Pape's favorite super fund. So with this one, so I'm just having a look at these amounts here. Which one is the highest? Yeah, looks to be age 36. No, 37 to 38. I don't know, sorry, 40. What is the highest amount of life insurance you would have? However, looking at the TPD insurance, they have it at the highest point between the ages of 26 to 36. And looking at those amounts as well, what really strikes me is if you do have a mortgage, most of us will have a mortgage that's a lot higher than 170,000 or even like 200,000 as per some of the other super funds default insurance amounts. So if you can no longer work again, you can't even pay off your full mortgage. You're still having to deal with mortgage repayments. So that's a really big issue with just relying on the insurances that's inside your super fund. Something I did actually want to ask is, do people want to type into the chat if you know, because I know not everyone knows off the top of their head, but who is your super with? I'm curious to see if we have any Australian super clients here or Host Plus Super. I'm with Australian Super. Who are you with, Matt?
I'm actually with a fund you can only get through an advisor. So I'm with MyNorth. So it's a secret AMP product. But I just like them because they had, they're an expensive fund, but they've got some investments in there that I like the look of, and you can't get in your typical kind of industry type fund. And so that's why I pay extra for it. But anyway.
Cool. Well, Caitlin, who's got with Host Plus. Does anyone else know who their super is with, or they've got no idea?
Or not willing to say, which is also completely fine.
Yeah. REST, yeah. REST was actually my first super fund. I think a lot of people start with REST if they start in the hospitality or retail industries.
Yeah.
We've got ART, we've got Australian Retirement Trust here. Michelle's with Australian Super. And you've got additional cover on top of the default amount. Awesome. Yeah. Amy's with Aware Super. Aware Super is definitely a very common one. That used to be First Plus Super. Then I think that merged with Care Super. Yeah.
Been a few consolidations recently. Look at that. We've got such a spread there too. Everyone's in different states. Everyone's got different super funds. This is fantastic.
We've got some diversity here.
So if you're interested and we haven't shown a screenshot of your particular fund and you are keen to go, well, what am I going to have at these different ages? Typically, you can Google just your super fund name and then product disclosure statement or PDS. However, sometimes you need to go one step further and Google the super fund name and then insurance guide. So they typically have them separately, because otherwise if you jam all of that information into just the product disclosure statement, you end up with hundreds of pages. So what they typically do is they'll go, here's a really brief summary of our product. If you want insurance information, go to the insurance guide. If you want the investment information, go to the investment guide. So typically you can just Google super fund name, insurance guide, and it should come up and give you a table similar to this. And if they don't have just an age-based table, if they just have units, then it'll have a similar table, but it'll say, this is how many units of cover you'll get at each age. So kind of like the one on the screen at the moment. And this is what each unit is worth at each particular stage in your life. And then if you go super deep into that document, you'll also be able to see the average or expected price of those units or level of cover at each age. So they change as well.
Yeah.
Awesome. Or you can get someone to do all that hard work for you.
We can do
that. So what are the major differences? So, it's not just, previously I said, look, we're not just looking at cost or anything at the moment. We just want to look at the amount. Now we're going into those other areas. So once you've figured out how much cover you need, what are the differences? Why don't I just increase my insurance with the current super fund? Because it's easy. It's all in one place. Awesome. So we're just going to look at that now. So just with the first one, Kat, you can do number 2. So just the options. So typically how it'll work is your super fund will have an agreement with one of the insurers in Australia, and they'll say, can you please offer XYZ to all of our members and give us a standard pricing structure? So that is up to the superannuation trustee. They can review that from time to time, but typically they stick with them for a number of years. And if it does change, so this actually happened to my fiance a couple of years back. She had some default cover. I think she was with Mercer Super, and then they changed their underlying insurer from one insurer to another. And so she got this big old letter that says, these are the changes in the actual amount of cover you're going to have, as well as the cost. So from one day to the next, she had completely different insurance offered through her super fund without any say in that and without any control, or, basically if she'd missed that letter, she never would have known. Whereas if you go to an advisor or a broker, they don't just look at one insurer. So they can look at every insurer on the market, as long as that insurer deals with advisors or brokers. But typically there's 10 main ones there. So I'm not going to list them all out, but you can pick and choose which insurer you want to go with based on their underwriting terms as well as their price.
Cool. So the next big difference between group insurance and retail insurance is the payment flexibility. So with your insurance that's inside super, that's the group insurance, your cover is just linked to the super fund and it's paid through the super fund. There's no other options there. And that means that you can't have trauma insurance. As I mentioned before, you can't actually own trauma insurance through super. You always need to pay for that personally. So you can't have trauma with group insurance, and you can't have child cover either, because that also always needs to be paid personally. While with retail insurance, you have a lot more options. So you can choose to pay for all of the insurance. You can choose to pay for all of the insurances personally, or you can choose to pay for life, TPD, and income protection insurances through super if you would like. And we can also tailor the structure in a way so that with the TPD and the income protection insurances, you can still have the majority of the benefits paid through super. And then there may be a small component that you pay personally to access some benefits and features that aren't normally available for the income protection and the TPD insurances if they're only owned through super. So you have a lot more options available to you with the retail insurances. Yeah.
And then third one, and we've got some more detail on each of these 4 topics on the next couple of slides, so we'll go into that in just a second. But number 3, can the policy change? With group insurance, yes, because the super funds are there to look after their members, they will from time to time make changes to how much cover you get and what that cover costs, or even which insurer they have in the background offering those terms, in the best interest of all of their members. So for some members, those changes will be fantastic. For other members, those changes might be really detrimental. So it's really important that anytime you get a letter from your super fund, make sure you're looking into that existing insurance that you had, making sure that you're across any changes that do occur over the years. With retail insurers, no. Once the policy is in force, it's a contract. So that policy is not going to change on you. The only typical changes that you're going to see with a retail policy is potentially an increase in the amount of cover that you actually have, which is called indexation. And that's just to ensure that if you're only claiming in 20 years after you've taken out your policy, the amount you get paid in 20 years is the equivalent of how much you needed today. You do have the option to say no to that. So you still have that control over how much cover you have at the end of the day. The pricing can, of course, go up because insurers need to be able to make sure that they're balancing how much money is coming in, how much is going out. But they can't decrease that cover on you unless you tell them to do that.
The last one is cost. So that's kind of complicated, and we're going to go through that in more detail. So generally, group insurance does tend to be quite cheap because they are offering cover to a group of clients, and so they're trying to keep the premiums affordable for everyone. But as you will see as we continue further on in the presentation, when you start to increase your insurances through super, it can sometimes end up being more the prices can end up being higher than if you took out that same level of cover through a retail insurer. But yeah, so it's a bit complicated in terms of costs and how that differs between them.
Alrighty, so here's just, if you're visual like I am, I need to draw things to be able to figure them out. So this is just going back to that first point. So what are your options? And so you can see on the left-hand side, we've got group insurance. You're with super fund, whatever. They're going to have one insurer in the background. So just, you know, for an example, Australian Super has TAL as their insurer in the background. TAL is a product that we can take you to directly. And you'll see later on, sometimes it might be better to actually go direct to TAL because one less person involved. Well, maybe swap out the super fund for an advisor or a broker. But yeah, the cover is going to be tailored to you. And that's totally up to the trustee. You've got no say over that. Whereas with the retail insurance, there's 10 or more insurers available, and you can pay for any of those from your existing super fund. So you can take out brand new insurance, some of it owned inside super, some of it outside, and not have to actually make any changes to whichever fund you're already with if you're really happy with how they're performing.
Cool. And going further into that payment flexibility, so on the left with group insurance, you can see that the cover is just linked to your super fund. So as I mentioned before, the premiums just paid, they come out of the cash balance of your super fund account. Probably something that's also really important to note about that is if you do decide to change super funds in the future and you take all the money from, say, Host Plus Super, for example, and transfer it over to Australian Super, if you had any insurances in Host Plus Super, that insurance just gets cancelled because there's no more money in the account to fund that insurance. So that's something that's really important to keep in mind. While with retail insurance, you can actually go with any retail insurer and have any super fund and have these superannuation premiums paid by your nominated super fund. And what that also does mean is you have the flexibility in the future of possibly changing your super fund. So say you have Australian Super, like I have today, and I set up my insurances with a particular retail insurer. I could decide 5 years from now, I don't want to be with Australian Super anymore. I'll switch over to, say, Uni Super, for example. And all I need to do is let my insurer know my Uni Super fund details, and they can just take those premiums from the Uni Super account. So it gives you a lot more flexibility to be able to keep your insurance, but pick whatever super fund you want.
This is just reiterating how policies can change. So this is a bit older now, but this was a screenshot from one particular fund's letter to their clients. I was going to say it was in their product disclosure statement. It definitely wasn't. This was just a letter or an email that they sent out where essentially they made some really major changes to their covers. So some of those dot points, hopefully it's not too small there, but you can see the third one there, they actually just overhauled how they charge insurance premiums altogether. So how much? They simplified their insurance categories, which maybe that's a good thing. One of the biggest things that we noticed was that there was a change to how income protection and total and permanent disability worked. So typically, if you've got a retail policy and you can't work for, say, 5 years, you'll be getting your income protection up to that point. Maybe after 5 years, you realize I'm never going back to work, and then you claim on your TPD as well. So you've got your 70% from income protection ongoing, and then you get that extra lump sum from TPD. What they did, this particular super fund, is they made a change where if you are on an ongoing income protection claim, which is considered a partial or temporary disability, and then you claim for total and permanent disability, their opinion is you can't be partially disabled or temporarily disabled as well as permanently disabled. So if you had an ongoing payment, even if that benefit said we'll pay you through to age 65, as soon as you hit that TPD claim and got approved, they would stop any further income protection payments. So that's a really terrible outcome if you're with that particular fund, or if you expected to have that long-term income protection plus that TPD amount. So then for any clients that had that, they have to make a decision between, do we want this smaller ongoing amount until whatever that benefit period is, or do we give that up to then get this lump sum of TPD that they might really need to then pay off their home or pay off some medical bills? So me personally, I hate that, but there's quite a few funds that actually do it. So that's one really big thing that I look out for my clients. And if they've got it, I really strongly encourage them to move away from that, because it's not a place you want to be. Whereas with retail covers, you've got this guaranteed renewable. So basically, it doesn't matter, once your policies have gone into force, it does not matter what happens to your situation, your finances, your health, your job, your family, it is guaranteed renewable. So they won't quiz you every single year to make sure you're still as healthy as you were, charge you more if you're not. They'll just keep taking that premium. So the only time they can cancel that policy on you is if you stop paying those premiums, or if you tell them to cancel the policy. And then further to what Kat mentioned earlier, if I'm young and healthy, take out all my cover, and then I get a really bad knee injury and I want to take out some extra cover. That knee injury can only impact the terms offered on the new cover that I've taken out. It cannot then be added to those previous policies that I had when my knee was still in good condition. So that's a really important factor there as well. And then the last one is, again, the cost there, which Kat's already touched on. It's really complicated, but really when it comes down to cost, for the retail side of things, every single detail about you is going to have some form of impact on how much you end up paying. So a really common question we get when we do our initial calls is, can you give me a ballpark? How much is it going to cost me? I wish I could tell people, because if I told you it's going to be 50% of your income and you know that there's no way you're going to pay for that, awesome. We can wrap up there. You've saved yourself some time and money. Unfortunately, that cost comes down to your age, your gender, your job, your BMI, your pastimes, your health, if I haven't mentioned that already, your state. So whichever state you're in can also impact how much you're paying by up to 10%. And literally every feature or thing about you can impact that. So we would love to be able to give you estimated quotes without knowing too much about you. It's just impossible. We could take an absolutely wild guess, but chances are we're going to be way off, and that's not helpful for you.
Cool. So now we'll go into the very meaty part of the presentation, which is our case studies. So we're going to look at some premium comparisons that we've done with some of our previous clients. And so the four super funds we're going to be looking at are Australian Super, Australian Retirement Trust, Aware Super, and Host Plus Super. So Australian Super, Australian Retirement Trust, and Aware Super are the top 3 public super funds in Australia by size. And in Host Plus Super, again, we've just added there because PAPE generally recommends them from the Barefoot Investor. So we'll go into the first case study. And just to start off with, this is where we've gotten the stats from. So we looked at 500 of our previous advice documents. And from those recommendations, we had 86 clients that didn't have any existing insurance. So that was pretty easy to tell them what to do. They didn't have any insurance. So we just recommended they take out insurance with a retail super fund. 195 of those clients, we actually recommend to replace their super fund insurance completely. But then there was still 219 that we actually recommended that they keep their existing super fund cover. And you're probably wondering why we would actually recommend that they do that. This would be in the situation that with any new insurances, they were expecting exclusions on those, because with their existing insurances through super, if that's just the default levels of insurance that you took out when you opened up the super fund, you've never been assessed on your health, which means you don't have any exclusions on that cover. So for these 219 clients, what we actually recommend they do is keep their existing super insurance and then just top up any gaps with new insurances. So that way, any exclusions would only apply to that new insurance. It wouldn't affect their existing cover. Okay. And this is some of the numbers that went behind these stats as well. Do you want to explain a bit more about this, Matt?
Yeah, sure. So this is going to be pretty messy when you're looking at it. We don't need you to dive in and get your head around every single one of those numbers. But what we did from out of those 500, we did a cost comparison between the retail cover that they had to begin with and what the group cover cost of the cover they had to begin with, and then what the equivalent level of retail cover would have been at the levels that we thought they needed. So you can see that a lot of these were typically, the group cover ended up being slightly more expensive at the levels that people needed, except for Aware Super, which was on average 7% cheaper, which is pretty handy if you're with Aware. Now, this is not an exhaustive list. There was 60 other clients in this data set. The reason we haven't shown them is they all had less than 5 with that particular super fund. So we've just kind of gone with the most common super funds that we see. But overall, all this is showing is typically on a like-for-like basis. So with the same level of life TPD and income protection cover with a retail insurer versus that cover that's available through their existing super fund, you can see it actually ended up cheaper. Now, that was including commissions that we would have been paid as advisors. So that commission amount is not payable by clients. It's actually payable directly to the advisor from the insurer. So it's not an extra cost to you. So this is really just to one of the common myths is just take out all your cover within your super fund. It's going to be the cheapest option. You don't have an advisor getting paid an exorbitant fee that's then being passed on to you. So that's all we're trying to show there is, surprisingly, even when that advisor gets their payment for the work that they've done for you, you might end up saving some money by going with those retail covers. So anytime we ever recommend someone replace this cover, we have a comparison table that says if you were to take out this level of cover that we think you need with your current super fund versus the insurer we've recommended, here is the cost difference. So they can see for themselves, okay, it is actually coming out cheaper, or, oh no, that's actually more expensive. Why have you done that? And then we can talk about if that new cover we've recommended is more expensive to them, what are the features and benefits of those policies that we think are worth paying that little bit extra money for? And then it's up to the client to then make that decision. Yep, willing to pay the extra and get these extra features, or nah, you're just trying to charge more. I'm going to stick with what I've got. But from that data set, we can see that the average cost for the retail cover was about $2,309. Average cost for the group cover, $3,286. Overall, 42% higher cost with the group cover. But yeah, anyway, I won't spend any more time on that because it is messy. But yeah, it's just to break one of those fun facts or common misconceptions. And so I'll keep going for now, Kat, and I'll give you the next one. What we wanted to do is show some real life examples. So we can do all the fancy graphs and tables and everything else, or we can make up that data if we really wanted to try and tell a story. Rather than do that, we'll just take some real life examples. So what we've got here in the top row, you can see the amount of cover that someone came to us with. And in the second column, you can see how much they were paying for those levels of covers when they came to us. The third column there is just showing if they were to take out that same level of cover with the recommended insurer that we ended up recommending, you can see what the cost difference would have been. So in this case, they came to us with Australian Super, who was reinsured by TAL, so they were paying $538. We ended up recommending an insurer who we won't mention because we don't need to. And so if they had gone directly from Australian Super to that recommended insurer at those levels of cover, they actually would have ended up paying 15% more, so $621. However, when we looked at the amounts of cover that we thought they needed, so life and TPD at $2.4 million and an income protection benefit of $12,717 per month, Australian Super would have charged them $9,059 per year, whereas the insurer that we recommended was $3,762 per year. So 58% cheaper even though in this initial scenario, you would have assumed that sticking with Australian super would have been the cheaper outcome for them. So you can see there was a percentage increase here of 1,582% with Australian super and a 505% increase in a recommended insurer. But of course, there is a percentage increase, a significant percentage increase in these cover amounts as well. So there has to be some sort of cost increase that comes along with that. All righty. Australian Retirement Trust for you, Kat.
Cool. All right. So with this case study, we looked at a client that was in their 40s that is a fleet manager earning about $130,000 per annum. And so they came to us with insurances with Australian Retirement Trust, only about $209,000 of life and TPD insurance, no income protection at all. And they were paying $589 per annum for this level of cover. So when we looked at the recommended insurer, they would have actually been paying less for the same amount of cover, so $300 per annum, which is 49% cheaper than Australian Retirement Trust. And then when we're looking at the recommended levels of cover as well, so for this client, we recommended 1.6 million of life and TPD insurance, and also income protection with a monthly benefit of 7,583, and with a benefit period to their age 65 as well. So if they took out our recommended level of cover through the Australian Retirement Trust, which is underwritten by AIA, their annual premium would have been $4,368. However, going with the recommended insurer, their annual premiums for this level of cover was $3,356. So in this case, the recommended insurer also ended up being cheaper for the recommended level of cover by 23%. So in both cases, with the default level of cover and the recommended level of cover, the retail insurer was cheaper. And you can see the increase in the premiums at the bottom. So going from Australian Retirement Trust's default cover to the recommended cover was 642% increase. And then going from the recommended insurers to the recommended level of cover from the default amount was 1,018% increase. So yeah, in this case, the client was better off going with the recommended retail insurer rather than Australian Retirement Trust in both scenarios.
Alrighty, case number 3, and we've also got case number 4, all really, really similar pictures where, you know, the recommended insurer is plus or minus a relatively small amount in most cases. But when we look at increasing to those larger levels of cover that most people actually need, yeah, there's a clear winner in terms of price. So this one is with Aware, came to us with $310,000 of life and TPD cover, $3,000 a month income protection, paying $710, whereas that recommended insurer for the same level of cover would have been about 33% cheaper, $478. But then when they increased it, so you can see a tenfold increase in cost with Aware directly, whereas, you know, half that with the recommended insurer, so $2,859 per year. So 500% increase versus a 960% increase there. But overall, 62% cheaper to go with that retail insurer. But case number 4, Kat, you can take it away. We really don't need to spend a huge amount of time on these ones because it's kind of just rinse and repeat with the last 4 cases.
Yeah. So last client, we've got someone in their 20s, graphic designer, earning about $90,000. So they came to us with default cover in their host boss super, just life and TPD insurance. They were paying $262 per annum for that. Going with the recommended insurer for that same amount of cover would have been cheaper by 17% at $218 per annum. And then when we looked at their personal situation to see how much cover they needed, so with the increased life, TPD, and income protection as well, through Host Plus Super, if they took out that same level of cover, it would have been $1,467 for them. But going with the recommended insurer, and it ended up being 14% cheaper, or $1,259 per annum. So yeah, this kind of dispels that myth that the group insurances within your super fund is always cheaper.
In some cases, it certainly is. And if that's the case, we'll tell our clients and again, go through the features and benefits that are included in that new policy if we've told them to replace it, just so, again, they can make that informed decision. Alrighty, so now to go through some common misconceptions. So I think we've got just a couple of myths here. Some of these you probably have figured out already based on some of the information or slides that we've gone through today. But starting off, so the only way to pay for premiums via super is to apply directly for insurance with that super fund. So as Kat mentioned earlier on, in the main differences between group and retail insurance, it's just not the case. So sure, if you apply for some extra or new insurance within your super fund, yes, you can pay for that via super. The alternative, you get a retail policy that can be held with any one of those 10 insurers, and you can pay for some of those covers, the ones that are owned inside super, from about 99% of the super funds that are out there, because there are some cases where you can't actually pay from your existing super fund, but it's pretty rare. And in those cases, we actually do have some workarounds. So that's another perk of chatting to someone that does this all day, every day. Over to you, Kat, for myth number 2.
Cool. So myth number 2 is if I move my super funds, I will lose my insurance. So I did touch on this earlier, that if you are just relying on the insurance that's inside your super fund, so the group insurance, if you move out of that super fund completely, yes, you will lose that insurance completely. But if you take out retail insurance through an advisor, you can still have the majority of that insurance paid through super. And then you can change super funds as much as you want, as long as you let the advisor or the insurer know your new super fund details. So which super fund it is, what your member number is. And because they only take those premiums out once per year, they can easily change that in the future to request those premiums from your new super funds. So taking out retail insurance through an advisor means that, yeah, you can still keep your insurance and change your super fund.
Alrighty, myth number 3. So the cover that I can see in my super fund will remain the same. So you've already heard me rant about this earlier on. I'm not going to go over it again, but when we're looking at those big tables between the 4 different super funds and how that changes over time, it's really important you do keep an eye on that, because most, not all, most super fund insurances you get by default, so you haven't had any input into how much or how little you have. If it's just been given, no questions asked, it will typically change over time. So please don't look at it in your 30s, go, sweet, I've got $300,000 of life and TPD, I'm going to have that forever, because it is very likely going to go down after approximately age 35. So just make sure you're keeping an eye on that. Some super funds will allow you to fix that cover. So basically you've got a certain amount, or you apply for a certain amount, and it's fixed. So whatever that amount is that's fixed, that will stay the same, but the cost of that cover will keep going up over time. But at least you know exactly how much you're going to get paid out if you should suffer one of those events. And then Kat's going to finish up with myth number 4.
Okay, so myth number 4, super fund cover will always be cheaper than retail insurance. As we showed you in those case studies, I don't think any of those actually had the super fund cover and being cheaper than the retail insurance. And we generally find that 9 times out of 10, as soon as you start increasing insurances, retail insurance tends to be cheaper. Sometimes, yes, with the default levels of cover, the super fund will be cheaper. But when you start to increase it, those costs tend to stack upon each other. So we find that, yeah, as I mentioned, 9 times out of 10, retail insurance ends up being cheaper than super fund cover when you're actually increasing it for your own personal situation. Okay, conclusion.
Got a quick conclusion. So we've got 6 tips or tricks or whatever you want to call them to leave with today. So number 1, most importantly, we may have said some negative things about group cover today. It's not to say that it's a waste of money and you should go out tonight and cancel it. Please don't do that. Please don't do that. Group insurance, as you can see when we showed you the last 500 recommendations, 220 of those we said to keep their group insurance. So it has its place. It can be very, very important in certain scenarios. All we want to get out of this is to please just look into what you have and determine if how much you have already, if you've never looked at it before, is enough for you. And if it is around how much you need, is it in the right place? Is it structured correctly? Can you potentially pay for some of those premiums out of cash flow instead of super? So just all we're trying to get across is please look at it, and we're trying to break some of those general myths of let me just do it with my super fund. It's always going to be cheaper. It's not always the case. Which literally is my next point. Group insurance isn't always cheaper. Although those 4 examples we showed, all of those did happen to be cheaper. I think, I can't remember all of the data now, but there were still quite a number of cases where the insurance with that existing super fund was actually cheaper. And again, in that case, we then make that decision to whether or not to keep that cover. And if we're still going to recommend replacing it, we need to justify it. And so tell you why paying a little bit extra is worth it. But all that is a comment from us. You still make the final call at the end of the day, or our clients do. So we can't force anyone to make any changes to their cover they don't want to make. Kat, you want to take away number 3?
Yeah, so 3 is not all policies are created equal. So we've gone into detail about some of the differences between group insurance and retail insurance, and some of those big differences are, say, with group insurance, you've got no control over the terms and conditions of the policy. The super fund trustee that manages the insurance that you have can change those at any time, and you don't have any say in that. While with retail insurances, they are guaranteed renewable. Once you have the insurances in place, they can't change any of the terms. But in saying that, there's also differences between, say, the different group insurances with the amounts of cover you get, with the definitions for TPD insurance, and then also there's differences with the retail insurers as well in terms of what benefits and features each policy offers. So an advisor will be able to help you navigate what those differences are, and maybe you can help find something that is most suitable for you. And then the 4th conclusion I want to make is knowing exactly what you are and not covered for is really important. So I think, like I myself, it's hard to separate myself from the fact because I've been in financial advice for so many years now, but I think there is a majority of Australians that just think that, whatever I have inside super is enough. But as we mentioned earlier, the average new mortgage is more than 500,000, and none of those default insurance amounts are even close to that. Some of them are not even half of that. So just knowing that, looking at your super fund statement or logging onto your super account and seeing how much cover you have is a really good first step for you to take to determine, well, is this enough for me, or do I need to investigate further?
Alrighty. And the last 2 really quickly. So cover that can't be reduced or changed without your instruction is worth every cent. So even though we've been harping on and on about how retail insurance generally or mostly comes out cheaper at the levels that most people need, even if it does come at an extra cost, it is worth it to know that you've got X amount of cover, and that same amount of cover is going to stay there until you say that it should change. That is worth the extra money. Insurance isn't cheap at the end of the day, but the reason it's not cheap is because it actually pays out. So if you've got a super ridiculously cheap policy, maybe have a really thorough review of it and see why it's so cheap. And the 6th point is just get advice. Whether it's through us or someone else, we don't mind. We would much rather you chat to someone rather than no one. And yeah, maybe you're not at the stage where you're ready or willing to pay for advice. That's why we do these sorts of things. We've got a YouTube channel with a heap of videos about pretty much every topic on insurance you can imagine. Most other financial advice practices are going to have their specialty areas and hopefully have similar resources. So if you're not quite ready to take the next step of actually chatting to an advisor, at least look at their website and see if they've got free resources that you can use to at least get you started. And then I think that's it. Time for Q&A. So thank you if you stuck with us through to this point. We'll let you all go very, very soon so you can all go to bed if you go to bed at 8 o'clock like I do. But so I'll start off with Caitlin's question. So your question is the age that the funds tables refer to the age of entry to the policy or the age you are when making the claim? So typically with that one, you will see those policies change each year, or at least the amounts of cover change at your birthday. So it's typically going to be the age you are at the time of that event. So you might take it out when you're 25 and get that low amount that's shown in the table. But if then you're healthy for the next 10 years, you're now 35, suddenly you need to make a claim, you should have seen those covers go up to that same level that's shown in that particular table for your fund that corresponds with someone at age 35. It can get more complicated, but we won't go into that any further, but hopefully that answers that question.
Yeah. Okay. I'll answer Amy's question. So how much does it cost to get recommendations or work with Skye? So we've got all those details available on our website. So for an individual or single person, it's $330. And for a couple, it's $495. And that cost covers you. So I'll kind of give a quick rundown on our process. So the first step is generally we'll book in a call with an advisor like Matt or myself, or we've got a few other advisors as well. And they'll go through the process with you, ask some questions about you, and just give you an idea of our process to see if we're the right person for you to work with. Then we will send you a link to our proposal fee. And if you're happy to go ahead, you pay the fee online, and then you get emailed an online form. And that's where you put in all the details about yourself that we need to be able to make that insurance recommendation. So details about your work, your health, your income, any interesting pastimes you have, because that can affect your insurances as well. And what we do with that information is we send it off anonymously to all the different insurance companies so we can determine which insurance company is the best one for you. Because say you do have a particular health issue, one insurer might be better than another. So we'll look at all those different insurers to compare which one's the best one for you. Then we will prepare the advice document based on that. So that initial proposal fee of $330 or $495, that covers us doing that initial research, preparing the advice document, and having a Zoom meeting with you as well, where we present that advice to you. And then from that point onwards, you can choose to take up our recommendations or not. And if you do go ahead with our recommendations, we get paid a commission by the insurer. So the only cost for you is that initial proposal fee of $330 for a single or $495 for a couple, plus the insurance premiums that you'll end up having. No, I might as well answer Rebecca's question too, because that's related. So is the fee tax deductible? Unfortunately not. For whatever reason, they have decided to make it that only advice fees related to investment advice is tax deductible, not insurance. Sometimes you might be able to find an accountant that can do some fancy accounting and make it tax deductible for you. But in most cases, it isn't actually tax deductible for you. Yeah.
Or if you're like me, if it's not a clear yes, don't try and claim a tax deduction. It's much easier that way than getting a knock on the door one day from the ATO asking for an explanation.
Yeah.
All right. And then the next question from Caitlin. So do exclusions ever reduce the premium because fewer circumstances can be claimed on? Fantastic question. I wish the answer was yes, but unfortunately the answer is no. So there's a couple of different outcomes when you go through that underwriting. So the first one is standard rates. So if you get standard rates for all your covers, we're going to call you a unicorn because it's that rare. So it's very, very rare for someone to have absolutely no medical history and get nothing excluded and nothing or no extra loadings on their policies. So not to scare you out of, even bothering, an exclusion or loading is not the end of the world. Because those exclusions are typically just saying, look, you've got a dodgy knee and that knee is excluded, The only time it's really going to exclude you is income protection TPD. So if you can never work again, or you can't work for a month or more due to your knee, the likelihood of that is pretty low, unless, of course, you're a really heavy manual worker. And in that case, you need to take those exclusions into account. Once upon a time, when I first started in advice, or at least working in financial planning, some insurers would allow you to opt in to a mental health exclusion. So right at the beginning of the policy, you would say, under no circumstance will I ever claim under mental health, and therefore you'd get a 15% discount. That is not something I would probably ever tell any of my clients to do, but it was particularly common at the time, because 15% is a pretty good discount. But when you look at how many people are actually claiming on mental health, it's really, really, really high. So in my personal opinion, I don't think 15% discount is worth excluding any mental health conditions.
Yeah, the majority of long-term income protection claims are actually due to mental health reasons. So, yeah.
Mental health and back exclusions are the two most common exclusions that we see. Back, because you can have a sore upper back, middle back, lower back, or a combination of the three. And your back's really important for most people to get around. And second of all, mental health, really, really quick to be excluded, because you and I can be diagnosed with the same condition, but our symptoms can be completely different. So you might handle the same condition really, really well. It may cause me to be unable to work. So insurers have to look at the worst possible outcome, and they do make a lot of assumptions. They assume the worst. And so even if you've spoken to someone, or a psychologist or a psychiatrist, one or two times, because you have a big project at work and you've been a little bit stressed, or it's been a particular life event, that could lead to a mental health exclusion. But the good news is that if it was just a one-off event and it does get excluded, you can typically get that reviewed after a couple of years. So again, it's not the end of the world, because at the end of the day, if it was just a one-time event that triggered that mental health condition or the exclusion, if there was no condition diagnosed, then the likelihood of you never being able to work again, or for a really, really long time due to mental health, is pretty low. So it's not something you need to be too concerned about. But that can be upsetting, because, I can chat to a psychologist once and then get told I have a mental health exclusion. And then I'm thinking, well, is there something wrong with me? The answer is no. It's just that if these insurers do offer you cover for that particular event, they're on the hook for potentially millions of dollars. So they do have to be really, really harsh. And if they weren't so harsh, a lot more people would be claiming, and insurance would be a lot more expensive, or just non-existent, because everyone would be claiming. And why wouldn't you just get paid to sit at home and watch movies rather than try and get better and go back to work?
Okay. I can see. Oh, I can mark it as a question. Okay, Caitlin, you've got a question. So is there any trauma insurance which can apply to birth or pregnancy, or is that a general exclusion? So trauma insurance is actually one of the insurances you can take out while you're pregnant and while you're also on maternity leave. So trauma, just to reiterate, that pays out a lump sum if you're diagnosed with a serious illness. Three most common types are cancer, heart attack, and stroke. Other common ones that I can think of quite easily are multiple sclerosis, rheumatoid arthritis, Crohn's disease, diabetes, things like that. So you can take out trauma insurance. Pretty much anyone could take out trauma insurance at any stage. The only thing where there might be a concern is if you have had a previous diagnosis of a serious illness that might result in an exclusion, or worst case scenario, you might not be able to get trauma insurance at all. However, there are other options as well. So it's definitely worth investigating that with an advisor if you have a tricky situation as well, because it can be quite complicated, because all the different insurers will look at that in different ways. So having an advisor will help you to do that research and determine what is the best option for your personal situation.
Just to add to that as well, each insurer is going to be very, very, very different. So that's why it can help to get someone to look into all those policies, or chat to someone that is familiar with those policies, because there is one insurer that is really good with this sort of thing, and they have an additional, basically specialized critical illness benefit for females. And it covers pregnancy complications, a very limited list, but also congenital abnormalities. So if your child is born with a certain list of conditions, you can actually get paid a partial benefit of that trauma cover. So yeah, definitely worth looking into or asking someone about who might know.
Awesome.
And Caitlin, don't be sorry for the questions. That's why we do this. It's a question and answer. If there were no questions, we'd have no answers. So it'd be a very, very boring segment.
Be very sad with no questions. But also we, like Matt and I and everyone at Skye, we really love what we do, and we like being able to educate our clients and empower you to learn about insurances so that you can make an informed decision on what to do that is best for you. So yeah, we love all these questions. Yeah. Cool. Do we have, I think that might have been the last one. Do we have any more at all?
That includes you, Caitlin. You're allowed to ask. Go for it, now or never. Or you can ask tomorrow.
She's booked into a chat tomorrow. So yeah, if you think of any other questions, you can also ask those during the phone call as well. Cool.
Otherwise, we'll give it one more minute, but I think everyone's gotten out all their questions. And yeah, you're welcome to, if you think of any questions after we jump off today, I think we're doing these webinars every single month. So there'll be another one every month is a new topic. So we try not to do the same thing 12 times a year. That'd be really pointless. But also, if you haven't ever chatted to us, you can book in that 15-minute call. No obligation, it's free. So even if you just have some questions you want answered that maybe will be more specific to you, you can ask there as well. But again, there's only so much we can give before actually knowing your situation. Otherwise, thanks so much for joining me, Kat. Thanks everyone for tuning in. Yeah, we'll probably wrap this up.